early June, getting back up to the high 34s. There were two peaks, October last year and March of this year, that got credibly over 25. And then we had that very sharp drop into early April, but immediate rebound. 2750 low. Next thing you know, a couple days later, you're in the 30s again. And in early June, we came up to high 34, and we had a momentum breakout at that point. Price was still below its prior highs. Okay, two highs. But momentum said, nope, it's over. Pull back. The sideways action in silver since last May, either side of about 32.50, by the way, up and down, up and down, up and down, is over. We're going up. And sure enough, next thing you know, we're up at 39. Right now we're 38.30, I think. I think silver's now into what you could call the acceleration phase, where the action is no longer this 4 steps up, 3 steps back type process. Instead, it's 8 steps up, 2 steps back. And I think we've entered that. And the same is true with the miners.
The U.S. stock market is currently witnessing the most extended and overinflated bull run in history. Since the 2009 bottom, the NASDAQ 100 has multiplied nearly 19 times, surpassing previous peaks like 1929, the 2000 dot-com bubble, and the 2007 pre-crash highs in both scope and length. Fueled by a decade of near-zero interest rates and massive monetary expansion, this unprecedented rally was built on easy money. The Federal Reserve's ultra-loose policies created an artificial sense of wealth, encouraging risk-taking at every level. But as history has shown, every bubble bursts, and now the cracks are beginning to show. Despite all-time highs in indexes like the S&P 500 and NASDAQ, leadership in the market has narrowed dramatically. Once dubbed the Magnificent Seven, only a few tech giants like Nvidia and Microsoft remain dominant, while others lag or decline. Outside the tech sector, the situation looks worse, particularly in healthcare and banking. These areas are breaking down on long-term momentum indicators, suggesting deeper structural problems. Even banks, despite making new highs, are resting on fragile technical ground. A slight slip could trigger a chain reaction. Momentum, not price, is now the canary in the coal mine, and it's flashing red.
The U.S. stock market's the biggest bubble it's ever had. Even 1929 bull peak, the duration and dimension of that bull market. The bull trend in 2000, the dot-com top, the dimension and duration of that bull market. Also the move from 2002 to 2007 top, which led, of course, to the bear market in 2009. Those were all far less overdone than this one. This one's 15 years old, and for the NASDAQ 100, it's been an 19-fold gain. The 2009 low. None of the other bull markets were of that multiple. Okay, and you can go look at Fed charts like M2 money supply, and look at the Fed funds rate chart, and you can see the monetary aspects at play, where we had the freest money rates in ever, for 10 of the last 15 years at near zero, and even when they uptick the rates to over 4%, et cetera. That historically, if you go back 75 years on their Fed funds rate chart from the St. Louis Fed, it's still in the very low end of that multi-decade period. So rates have been cheap, money's free, and therefore people spend it like it's free.
Right.
And then reality finally bites them, because reality always ultimately wins. It may be delayed and so forth, but that's what's happening. I think the stock market is topping. And the money that's there is going elsewhere, and there'll be more money to go elsewhere, because when the central bank and the central government panic over bad data points, once the stock market rolls over, it will go somewhere. Yeah. And it will go to gold and silver. Right. Used to go to T-bonds, but now it's not doing that either. So we're left with one alternative. Right. That's the reality we're facing, except it's bigger than ever before. And there are a lot of sectors and symbols, like within the Mag 7 even, that aren't anywhere near coming back to the prior highs. So the S&P, the NASDAQ 100, Nvidia, and a few others, Microsoft, for example, all look like they're still the leaders. Well, the Mag 7 doesn't exist anymore. Flip through even just the price charts and you see it's more like the Mag 2 or 3. Okay.
Wow.
So you're losing leadership. And we also watch other things that most folks don't watch, and that would be sectors that kick you in the gut but aren't a topic of conversation. Healthcare sector to us looks like a massive top that will take it down big time.
Huh.
And it's not recouping, okay? It broke a month or two ago. It broke annual momentum, a floor that goes back more than a decade on momentum, not on price.
Hmm.
And price is now joining in. It's very weak. That's 11% of the S&P healthcare
Oh,
sector.
oh, yeah.
And then when you look at the banks, right now, some of the banks have also made new highs, like the S&P. But when you run short to intermediate term momentum, and we did that the other day, they're all dancing on a momentum floor that has been used too many times, meaning you keep coming back to the same flat floor. You can't see it on the price chart. When you do that on momentum and you use something over and over as support or resistance, in this case support, when you break it, whoosh, okay, the floorboard broke.
Yeah.
And they're all dancing on the same vulnerable structures that look like, in the next week or two, don't be shocked if all of a sudden the floor opens up there and people say, what's going on? What's going on? So look at other sectors is our strong suggestion, and other market categories that will have wave effects on the stock market, like the T-bonds. When you establish a high and everybody thinks, oh, well, that was it, and finally you overcome it.
Yeah.
Which is, by the way, quite common at some tops to have a false overcoming of a prior high. The people think, oh, the game's on again. In fact, in 1958, the book was written by Edwards and McGee called Technical Analysis of Stock Trends, price chart analysis only. I bought it when I first got into business, and it has a topping pattern that few remember or note, because if they did, you'd see it on CNBC now. You have what's called, with the potential anyway, of a broadening top. What a broadening top is where you make a peak, have a drop, make a higher peak, make a lower low, and make a higher high again. So 3 consecutive highs that, take out the prior one. And so instead of a triangle narrowing, you got one widening. You follow me? Okay, that's what you look like on the S&P and NASDAQ right now. So you don't want to have any near-term rollover from current levels or near current levels that gets you back down, for example, it's only talking 1% or 2, below the high we saw in January. Because then what it says is, I trapped you. It's a broadening top pattern.
Yeah.
And it's not something people talk about. I've never heard it discussed, that technical pattern. We look at momentum mainly, but I noticed that the other day. And I think that's probably what we're working on, is the completing a broadening top pattern.
Yeah.
And the resolution of those is very nasty.
Historically, when equities falter, investors flee to U.S. Treasury bonds. But not this time. The long end of the bond market, especially the 30-year Treasury, is behaving erratically. Bond futures dropped from 121 to 111 in mere days earlier this year, a staggering collapse for such a massive market. With government debt soaring and inflation lingering, confidence in U.S. debt is eroding. Unlike in past crises when both bonds and gold rallied, only gold appears to be attracting real capital now. If bonds break critical support again, we could see a systemic event. And remember, the bond market dwarfs the stock market. While the mainstream focuses on equities, precious metals are quietly building strength. Gold has moved sideways since April, not showing typical signs of a top, while silver and mining stocks are surging ahead. Silver has entered an acceleration phase, breaking out of its long consolidation range and climbing toward $39. Mining stocks are now outperforming gold itself, a reliable signal that the metals market is entering a new bull cycle. Momentum indicators confirm strength beneath the surface. With credit stress rising and traditional safe havens faltering, gold and silver are emerging as the last reliable refuges in an increasingly unstable market.
Historically, if you go back to 2000 to 2002, stock market, bear market, big one. 2007 to 2009, big bear market. During that time, 2 alternatives stood out that went up: T-bonds and gold. Bond price go up, yields go down, meaning, and gold goes up. This time around, it's only gold. So we've had this effectively, if you'll draw a line sideways through the S&P going back a full year, you'll see we just oscillated to either side of this line, higher highs, lower lows, etc. So it's really not going anywhere, but the T-bonds have not responded in the normal way, meaning demand takes them up, yields go down. This is the end of the market the Fed doesn't really control well. It's the long end. Okay. They're acting very sick right now. Now, we've had, Jamie Dimon and others have said this is a disaster situation. This time it's not going to be avoided. This has to be taken care of. We have to cut government spending. Because you can't play the game forever. It's been decades of, it's game playing and money printing. Right now, T-bonds are trading around 112, 30-year T-bond futures. Back in April, there was a rally. They got up to 121, and 2 days later, they dropped to 111. 2 days. I mean, that for the bonds, that's an enormous crash. Sure. Since then, they've been groping at the bottom end of that peak to collapse zone. Right now, the 112 area. You get down in the 110s again on T-bond futures. We think there could be a headline type market event in that category. That category, by the way, is bigger than the entire U.S. stock market.
Wow.
In terms of assets.
Sure.
So watch the T-bonds, because if they start to ooze on down into the 110s and close a month out down in that area, there could be a period where that's a headline event. And I don't think stock market's going to be going up during that time.
Yeah.
Anyway.
Yeah.
So it leaves monetary metals as really your only portfolio alternative. That's the end of the market that's choking. And even it's been here since 2022. The T-bonds, you could draw a line sideways, basically, and you've been oscillating it either way. So in other words, we have had no relief on the long end of the debt market. So you got to watch things like commercial real estate sector. We all know that people's credit card limits are maxed out. Some of them are past due. It's increasing. So the long end of that market has a noose around too many individuals and corporations and governments. Do not take your eyes off of it. When gold peaks or bottoms, 2011 peak, 2015 bear low, go back and look at them. They're isolated. So when you make the high, you puke, sharply. And back then it was several $100s.
Right.
You could never get back to the high. You tried all during the year 2012 to get back up to that 1920 level. The best you could do is 1790 a couple times. You couldn't get back to it. So in other words, it was isolated, thin air. Get the point. This time since April, it's no drop. It's just lateral, like it's asleep. That's not the way gold tops. And momentum tells us there's not anything to break here. So in other words, if price looks like it's breaking something, but momentum doesn't, don't trust price. Right now, momentum says, no, I'm just having a cooling off period. I'm not breaking anything. And price isn't either. It's like Dullsville.
Yeah.
And I think it's going to wake up shortly and zoom out of that range again. But notice during that 4-month period, what's happened to gold miners and silver.
Yeah, they've picked up.
No, they've been going up.
Yeah.
And sharply so compared to gold. So the relationship between those subsectors in the monetary metal category is they're shifting to outperform versus gold. In early June, getting back up to the high 34s, there were two peaks, October last year and March of this year, that got credibly over 25. And then we had that very sharp drop in early April, but immediate rebound. 2750 low. Next thing you know, a couple days later, you're in the 30s again. And in early June, we came up to high 34, and we had a momentum breakout at that point. Price was still below its prior highs. Two highs. But momentum said, nope, it's over. Pull back. The sideways action in silver since last May, either side of about 3250, by the way, up and down, up and down, up and down, is over. We're going up. And sure enough, next thing you know, we're up at 39. Right now we're 38.30, I think. I think silver's now into what you could call the acceleration phase, where the action is no longer this 4 steps up, 3 steps back type process. Instead, it's 8 steps up, 2 steps back. And I think we've entered that. And the same is true with the miners.